Okay, so welcome to another investor education webinar. Today is going to be all about finance, and joining me as the guest expert is Diana McKenzie from LOANPORT. Hi, Di.
Hi, how you going, Ash?
Good. Now, I guess I probably should start off by putting a little bit of a disclaimer on this, that we're going to be talking about sort of personal opinions as well throughout the piece, without what we think and what you think is sort of the best ways to manage finance. And so everyone should do their own research and take their personal circumstances into consideration when working out what is best for them. Is that sort of about how a disclaimer goes, isn't it?
Yep, definitely.
Excellent. Because I know that there is something we're going to be talking about today that is, it could be something that you hear differently. And that's actually about interest only versus principal and interest. So when we get to that, that's probably the main one that I'm thinking is going to be, a little bit different. Everyone's going to have their own opinion on that. So, we'll get talking about that shortly. So really what I want to make sure that we're doing is getting landlords or investors, or anyone, to be honest, to be a little bit more curious with finance, knowing what questions to ask, and trying to cover some things that they maybe didn't know, because you don't know what you don't know. So we sort of just want to cover lots of things, and maybe that might prompt questions that people have to ask their mortgage brokers. If you don't have a mortgage broker, Di and her team are a fantastic option to reach out to as well to help with that. So that's sort of the idea for these sessions. If you've got any questions, you can pop them into the Q&A, or you can, if you're watching the replay, then you can email us separately for any questions or some advice. So my first question for you is, at what stage should investors be speaking to a finance broker when they decide, yep, I want to buy a property?
As soon as you decide that you want to buy an investment property, I think that's the best time to start talking to a mortgage broker. One of the things that we do is we make sure that we collect all of your information and do a full assessment of it and get you ready for pre-approval, so that when you go out and start looking for an investment property, you know exactly how much you can borrow.
Yeah. Do you find, or are you hearing much about selling agents wanting pre-approval before putting offers in?
So we're Perth based, and it's a pretty competitive market at the moment. So most of the real estate agents and even the buyers agents are wanting proof that you have pre-approval in place. That can consist of two things. You can get a letter of eligibility from your broker, and normally they will have assessed all of your information to give you a letter of eligibility, or you can submit an application to the lender that you're looking at going with and get a pre-approval from them. And I think that's the best option, because most of the time those lenders assess and look at your income and all of your other information, and sometimes there might be something that we're not looking at. We're looking at something in a different way, and so at least we can confirm your borrowing capacity with that lender.
Yeah, excellent. And I'm still amazed at the amount of people that don't know this, so I'm going to get you to explain it to them. What is the benefit of using a finance broker as opposed to going straight to the bank? Okay,
so I think it's really important, particularly if you're going to invest in one or more properties, to have a mortgage broker, because when you go to a lender, they've only got their one policy. But when you use a mortgage broker, we have access to over 35 lenders, and we have access to all their different policies. And the way they look at your income and equity in property, other properties, and sometimes even how they want to structure property investment loans can be different. And so a mortgage broker can give you all of that information and work out what lender will be the best fit for you.
And I feel like most investors these days are probably quite flexible with who they go with because they just want the money. But if someone does like specifically want to be using a certain bank, then you can still use the finance broker and just say to them, listen, I'm really loyal to this bank and I don't really want to look at any other options. I mean, you can still do that, can't you?
Yeah, absolutely. The thing that I do is I always look at who my clients already bank with, and I always show them what those lenders are offering when it comes to property investment loans. And I then compare that to what else is in the market. So then you might decide to go with that lender that you have got a long-term relationship with, but at least you know what else is out there. So, and as part of our best interest duty, we're required to let you know what else is available.
Yeah, I mean, I can't see, do you ever see any clients where you give them 2 or 3 options and they choose because they're stubborn, they choose their bank that they want, even though it's maybe going to cost them more? I mean, does that ever happen?
Yeah, I have it all the time.
Really?
Yeah.
Wow, that's good for loyalty.
Yeah, a lot of people are still loyal to their banks. The thing that I think nowadays is that with apps and internet banking and the closing of branches, it's pretty easy to have multiple lenders because the apps are on your phone and you can look up what your home loan balance is at any time and what's in your offset account and what the interest rate is. You're not waiting for that monthly statement to come through. So I think the world of apps and digital banking has really provided people with a lot more options and made it a lot easier to have a number of different lenders.
Yep. I didn't ask this before, but I just can quickly find out, and it's going to be variable, but how long does that pre-approval process take? Because like if someone goes, oh, I want to buy an investment property, would that pre-approval like take between 2 and 4 weeks or less or more?
Look, that's really going to depend on the broker and the processes and systems that they have in place. Because we collect all of your information, once we have that information and you've decided on a lender, it's normally a 1 to 2 week process. And then the pre-approval usually lasts up to 3 months. And then normally you just need to update the lender with some additional pay slips and just check that your asset, there's been no major change to your financial position, and then we can usually extend the pre-approval.
And I would imagine just from being in the office that there's a lot of investors and people, not just investors, that probably don't willingly provide all their information to you, which is going to make the process a lot longer if your finance broker has to drag that information out of you. So I guess if you want this to happen quite quickly, make sure that you're providing the finance broker with everything they ask for. Don't just think, oh, I'll just not give them that because it's going to take a lot longer. Would that be fair to say?
You should firstly find a mortgage broker that does ask you for everything, whether it's home loan statements, transaction statements, income, and because that's what they really need to make a good or true assessment of what your borrowing capacity is. If your broker isn't asking for all of the information, then the chances are something's going to be missed, and that could really affect your loan application when you want to get unconditional approval for something.
And you don't really care about how much they've got on their credit card debt, all of that. You just need the information. Like, I guess we probably, some people might feel a little bit like maybe embarrassed to provide all their stuff to you if there's something they're conscious about, but you do it all the time. Like you're not thinking with that same emotional hat. It's just like, okay, it's just a process. So I guess that would probably be the reason why a lot of people don't just give you all their information because maybe they're embarrassed with debt.
Yeah, I think, a lot of people do still feel that their information is quite confidential, and especially when new clients come in, they're kind of probably a little bit more guarded at providing their information. But you're right, Ash, we just look at the numbers. The numbers tell the story. Why we want all of your information is because we need to see what the lender is going to see. And it's better that we have a look at it and we pick up any potential issues with it before it goes to the lender. Sometimes when you're applying for a loan and you're going up to your maximum borrowing capacity, you get one shot at a loan and the loan application. And if you muck it up because you haven't disclosed all the information, that might potentially, you might lose the property that you really want.
Exactly. Now let's get into the controversial one. Again, this is just personal opinions that we're sharing here. Interest only versus principal and interest. What is, if you maybe can explain the difference and why people choose one or the other?
Interest only loans are where you're just paying the interest. You're not paying anything off the principal. So every month that varies. The interest is charged monthly, so you'll always have a monthly repayment on an interest only loan. And whereas principal and interest, you are slowly paying some principal off the loan as well. So that means that the debt is slowly reducing over time. The difference between interest only and principal and interest loans are normally the principal and interest rates are lower than the interest only loans. And they are people that are wanting wealth preservation and to reduce their overall debt will often choose a principal and interest loan. I always say if that's your only debt that you have, you should pay principal and interest on your investment property. And I also encourage all of my clients to pay principal and interest, because when you reach that retirement age, you want to get the rental income from that to live off. You don't want to keep paying off a loan. So I strongly recommend principal and interest. It goes against what most accountants will say for investment properties. But I've been a mortgage broker for 20 years, and I can say, hand on my heart, nobody has ever come back to me and said, I wish I didn't pay principal and interest. But heaps of clients have come back to me and said, I wish I didn't pay interest only. I wish I'd actually listened to what you said, because now I've still got the same amount of debt as what I started with.
This is this is a classic thing that I talk about in all different aspects of life, but you can choose to make your now a little bit harder to make your future easier, or you can choose to make now a bit easier with interest only, but it's going to make your future that little bit harder. So it's about choosing that hard. And I just find that that's something that people should be thinking a lot more. It's not just about now, it's about that future. So would it make a difference, or would your opinion be different if someone was only planning on holding on to their investment property for less than 5 years versus someone that wants to hold on to it for 30?
No, my opinion wouldn't change. In fact, I would even more recommend principal and interest repayments, because when you're only looking at holding on to something for a short period of time, you're really playing the market. And what happens if there is some changes in the market and prices go down or reduce a bit, then you, if you've only been paying interest only and the loan stays the same, you're not going to have built up as much equity. So definitely, if you're thinking of a property investment short term, I would really recommend principal and interest. Interest only, I often say, comes into play when you've got more than one investment property. So when my clients are moving on to their second or third investment properties, then it will definitely free up some cash flow. So in those cases, then I would say, all right, let's go to interest only. Or I've got someone at the moment who's got $1 million property with a $400,000 loan. They've been paying principal and interest for the last 10 years. They've got heaps of equity in the property. Is it safe to go interest only now? I think it is, because they've got so much equity already built up in the property. So yeah, in that case, I've recommended interest only.
And if that's what's going to help someone as well potentially get to the next step of that multiple portfolio, then I can see the reason for doing that as well. But I don't know if it was you or someone else that said, if you can't afford to pay principal and interest, you can't afford to have an investment property. So you need Was it you?
It was absolutely
You
me.
need to be able to afford to do that if you had to.
Yeah, absolutely. So what happens with interest only is when you say you get an interest only loan for 5 years, this is another big reason why I would choose principal and interest. At the end of that 5 years, the principal, it reverts to principal and interest over 25 years, not the 30-year loan term. So you either need to refinance your interest only loan after 5 years. But what happens if something's happened and your financial position has changed? Like if you're a couple and one of you is on paternity leave and your income is lower and you don't have the same servicing ability to refinance that loan, and then all of a sudden your mortgage repayment jumps up and you can cause a lot of financial stress. And then you can be stuck in kind of a mortgage prison because you can't move and you've got now a high loan repayment. And in that case, you would be forced to probably sell the property.
Yeah, which is a shame. Are you seeing investors making any mistakes when they're coming to you to get their finance? Are there any just mistakes or things that you wish they had known prior?
I think that one of the things that I really try and understand when I'm talking to clients is what they're wanting to achieve through property investment. Some of the mistakes are definitely not getting pre-approved because, you know, you can face too many surprises if you don't have pre-approval and they just come to me and say, oh, I bought an investment property, just sort out the finance for me. The other thing is a mistake that people often make is how they structure their loans. And this is going to depend on whether you're buying a property in your individual name or you're buying a property in a trust or company name as well. But you want to get your loan structure right and you want to have some input from your accountant on that because, there's lots of people have a lot of ideas of what they can and can't claim with regards to loans and interest and that. So I think that it's important to structure it properly and not just go for a good rate, but go for a good lender that provides good service and can also accommodate your structure and also can follow through with your long-term property investment strategy.
Yeah, I think one of the biggest problems that I see, which would be the same in your industry, is that people are often talking to their mate and taking advice on their mate, from their mate, and their mate's told them to do this or their mate's done this. It's a big issue.
Yeah. One of the biggest problems that we face is if someone is moving from their owner-occupied home and they're turning that into an investment property and they want to increase the loan. And technically that's not, the loan increase isn't really for investment purposes. So what happens is they're not supposed to claim that portion of the loan on tax, and that's probably the most common loan structuring issue that people have. I mean, I can't tell them what loan amount to have, but in those situations, I'll always refer them back to their accountant and double check that all the interest on that loan is going to be tax deductible, because it just keeps things simpler. And I always say to people, when you're buying an investment property, treat it like you're buying into a business, put a commercial hat on. So keep the loan separate from any personal lending. So it's only for investment purposes. Also have a separate transactional account that your rent goes into so that you're not kind of like overlapping the costs of the investment property with your personal finances. So if you have a separate transaction account where the repayments come from, the rent goes into. Also, if you need to top it up with any shortfall from month to month, you can see exactly how much that property is costing you. And you can also have all your expenses for that property coming out of the transaction account too. So my suggestion is keep it separate from all your other day-to-day banking.
So that sort of leads me into the next question, which is having people that are owning multiple properties, having them stand alone as opposed to cross collateral. Is it?
Yeah.
Couldn't say before, cross collateralizing. Yeah, that one. What's your thoughts on that?
Look, ideally, if you, it is better for your investment properties to stand alone. And one of the big reasons why you would do that is if you need to sell quickly or in a downward market and you are going to lose money on that property, then you haven't got other property tied up where the bank will, you know, kind of, they will retain the security for the leftover loan. So you still have to pay it back. At the end of the day, if you owe the bank money, they're going to chase you down the street until you pay it back. But the other thing with not crossing your loans is that you can have loans with different banks. So you might have a major lender that you do your first investment property with, but then because your borrowing capacity is better with, you know, another lender for your second property, you don't want them crossed. You want them to be standing on their own. What often happens is many of you have probably heard of the term debt recycling, which is one of the things that I wanted to talk about today. And that's when you take a portion of your home loan, a loan out on that, and then you use that for investment purposes. So if you want to buy a property for $500,000, you might go and take $125,000, your 20% deposit and fees, a loan against your house for that, and then you'll use that $125,000 as your deposit for your investment property loan. So then you end up with two loans for the investment property. You have your $125,000 that you've debt recycled out of your house, and then you have your $400,000 loan just against the investment property. That's the most ideal situation. But if you're only going to buy one investment property and you're going with the same bank that you already bank with, and you just want the simplicity of one loan, I don't think it really hurts to cross collateralize, because like I said, if you owe them money, they're going to chase you for it. But if your strategy is to have more than one investment property, you definitely want to consider making them separate, standalone.
Yeah, perfect. So we know that credit cards can play a factor in your borrowing capacity. So can Afterpay and children. So would they be the three most common things that maybe people don't realize? And are you able to like give an example of what effect it could potentially have on your borrowing capacity, like in an average situation? Like what are they looking at?
Yeah, so yeah, you're right, that all those things do affect how much you can borrow. The one thing that is affecting people's borrowing capacity quite a bit at the moment is HECS debt. There's talk around the rules around that changing, and Commonwealth Bank have just come out with a new policy on how they will treat HECS debt in servicing. So at the moment, HECS debt is treated as a liability, and the amount that is used for that liability depends on what your income is. So for example, if you earn $120,000 a year, the liability for that is $750 a month. So that's like having a personal loan. That can affect your borrowing capacity by about $70,000. So I just had one last night actually, and it was $60,000 debt, $120,000 income was affecting her borrowing by $70,000. The other big thing that comes up a lot is people having car loans. So the average $80,000 to $100,000 car loan is between maybe $1,500 to $1,900 a month, and that can affect your borrowing capacity by about $150,000. You know, just generally speaking, it depends on lots of other factors, but it just gives you a bit of an idea. So if you want to buy an investment property, but you're also thinking about buying a car and getting a car loan, it's probably better to talk to, I'm not saying don't get a car loan, but I'll just talk to a mortgage broker about how that's going to affect your borrowing capacity, because, you know, it might be better to pay cash for the car and have a higher loan for your investment property.
Yeah, there's a funny meme that's going around where it's a meme of a real estate agent, and it says, "Oh, I heard you use someone else to buy a property from. Congratulations, you should go buy yourself a car." Like as a bit of a, that's going to stuff you up. It's yeah, I thought that was
Real.
one.
And buy now, pay later and afterpay aren't too bad because they're not normally big amounts and people can normally close them fairly easily. How many kids you have does affect living expenses. Some of the other things that can affect borrowing capacity, and I find this a bit interesting, but with living expenses, some lenders, if you want to buy an investment property on your own, but you're married with 2 kids, some lenders will make you use living expenses for the whole household. If your partner is working, there's other lenders that do what we call apportionment of debt. So that then just gives you a higher borrowing capacity. So they'll take into account, even though the partner isn't going on the title or the loan, they'll still take into account that there is more income coming into the household and that you're not 100% responsible for the living expenses. So that's good to know if your lender is saying your living expenses, need to be taken into account for the whole household. There are lenders out there that will what we call apportion the debt. So that's a little handy thing to know.
And so would that be something similar with single parents with like 50-50 custody and things like that in terms of proportioning the dependents? Does that happen?
Yeah, the lenders are different with that and it comes up a lot. So we have to disclose how many kids you've got. You can't just say you've got 2 when you've got 3. But if you only have your kids for 50% of the time or more, then yes, we can mitigate that with the lender and let them know that your living expenses might be lower than a single person with 3 kids because you only have your kids half the time. So yeah.
And random question, because I haven't asked this before, is there the dependents, it comes down to how many children you have. Does it depend on their ages?
Well, if you want to use your child maintenance and any Centrelink income, yeah, it can affect your ages. So there are some lenders that allow the 100% Centrelink and family and child maintenance until the kids are 18. And then there's other lenders that have cut-offs. They're all different, like some cut off at 8, 12. Most of them have the general rule that the payment needs to continue to be payable for the next 5 years. So I suppose in saying that most of them cut off being able to use that income once the kids are 13.
I was just thinking more like, if my children were aged, 1, 3 and 5, I should be able to borrow more and have more borrowing capacity than when they're currently 12, 14 and 16, where they cost me a lot more and I shouldn't be allowed to borrow much more money because they cost me more.
No, that doesn't work like that. No. But some of the things that you do need to be mindful of is that private education often comes not included in normal living expenses. It's outside of the Henderson expenditure measure. So if you have, and there's some lenders treat that differently. The other thing is health insurance. So some lenders include that within HEM and others include it outside of HEM. So if you're finding that your borrowing capacity, if you've gone to a lender and you're finding your borrowing capacity is not quite what you want it to be, I think that's a good time to check in with a broker and see what else they can offer you.
So do you mean, like, for example, if I pay $300 a month in health insurance, some banks might take that into account with my expenses and some won't?
Yeah, some will put it outside of the HEM. We call it HEM, it's the standard living expenses that the banks say we need to use. So the banks have, they're all a little bit different, but they have their standard living expenses. So we need to use that. If we go under that, they will ask us for more information on your transactions and why we think that your living expenses are lower. And then in saying that, they will still use whatever their benchmark is. So usually what I do is even if someone's living expenses are a bit low, I'll still make it the benchmark that the bank is setting to avoid, having to provide too much more information.
Yeah, and so exactly the benefit of using that finance broker, so they can assess everything and then go, yeah, but I think this bank is going to be the one because they don't include this, and in your borrowing capacity, etc.
Yeah, and the credit policies with the banks are continuing to change more and more, and the gaps are widening. Like some lenders like contractors, some don't, some are good with FIFO workers, some treat FIFO workers as casual, so they reduce how much of your income they will use. And so the policies are always changing, and that's what a broker keeps up to date with, those policies. And you need to, when you're looking for a broker, you need to look for a broker that doesn't just write 1 or 2 deals a month. Look for a broker that has some experience. I often say to people, whether they want to come to LoanPort or go elsewhere, ask your broker, do they have their own investment properties, or have they had their own investment properties? Because that experience will be important in the guidance that they give you.
Yeah, absolutely. And last question is, how often should people review their mortgage? Is it something people are doing yearly, 5-yearly? What should they be doing?
If you're on a fixed rate, you don't really need to review your home loan until about a month or 2 before the fixed rate comes up. If you have a variable home loan, then I definitely recommend that you review your rate every 6 to 12 months. We have access to what we call pricing tools with most of the lenders, where if we've got the necessary information like your loan amount and your account numbers and names, we can actually do what we call a pricing request to see if they will improve the interest rate that you are currently on. And at LoanPort, we're doing that on average about every 4 months. We have someone full-time dedicated to doing that. We also have a really good tool called Rate Tracker, where people can, with open banking, they can link their home loan accounts to the Rate Tracker app, and they can keep an eye on their rates all the time and checking whether it's still a good rate or not. And then from there, if it gets to the point they feel like it's not a great rate, then we can do a new pricing request for them. So,
okay, so if they want to do that, they could just email you through and say, I'm interested in your rate tracker.
Yeah. If anyone's interested in being on the Rate Tracker, it doesn't cost you anything. You do have to go through open banking. So you do, even though it's that your information is not retained, you do have to link your bank account numbers to it so that they can track your interest rate with the lender. And
but it's all like encrypted in the back end and properly.
It's another digital tool, but it's really handy, and I'm finding that our clients are loving it, because rather than having to call us all the time and ask us to review their interest rate, they can just go onto Rate Tracker and check their rate, and it gives them a rating. Like it will say whether their current interest rate is a 10 or a 9 or a 7, and whether it needs attention. And it's just, property investors love it, because often they've got more than one loan and they're wanting to try and keep tabs. And this is one way of keeping tab of all your loans, even if they're with different lenders in one place.
Yeah, absolutely. And I'll finish off with that good news story where we had at SOCO, we were doing that annual investor audit, and during that time, I remember we always invite our clients to have Dice sit in for those discussions. So if you do want to have some advice from finance brokers, that's a great opportunity. And there was a client that we got you to check his mortgage, and he ends up getting you to check a second mortgage that he had over in Melbourne. And I think just by doing a quick review that didn't cost him anything and just took him, however, 15 minutes, half an hour or whatever, it was like 4,100 a year or something like that.
It was more than that. We got his interest rate down by 1%. So when he bought his investment property, he bought it for what we call at a high loan value ratio. It was 90%. He only had a 10% deposit, and he went with a lender that was what we call a second tier lender, and it had a high interest rate. And that's all fine, because that's what we didn't do that loan, but that's what met his needs. I can see that at that time. But after 12 months, it was time to review it because the property value had gone up. He could do an 80% loan, which attracts a much lower interest rate, and he could change to a main lender. And I think he ended up saving about 1.5%. I think it was like $9,000 a year. It was significant. It was on $600,000 worth of lending.
Yeah, which was great. I know that it wasn't anything necessarily to do with, well, it sort of was, but like I know that the savings was all on the mortgage, but it was one of those examples I use where SOCO had instigated the investor audit to check these things, and by doing that proactiveness as a property manager, it's led him to get in touch with you and save that money. And it sort of makes us feel good that we're able to, not for him to get his management fees back, but it's like we've ultimately helped you save that much money, and that's the purpose of having good property managers and good finance brokers.
Yeah, and it's a perfect time to check your loan when you're reviewing what's happening on the property management side of things. Why not just check your home loan as well? It doesn't take long. It's it's pretty easy to work out. I can probably work it out in 5 minutes whether someone's on the right product or there's probably going to be something better for them. And then take it to the next level. So all you're doing is doing a quick review and just getting a bit of an opinion on whether it's still a good rate or whether it might be time to look at something else.
Yeah, so inside our office, we remind our clients when their tenant has renewed their lease. So generally when they've renewed their lease, they've renewed at a higher rent, and at the moment they are anyway. And so we find that that's a great time if someone was thinking of buying another property. Now they've got that extra income in their new lease agreement. It's a great time to then potentially go to the finance broker and say, I'm now collecting this much in weekly rent. What's now my borrowing capacity? So if you're an investor and you someone else looks after your property or you're over east, then that's where I would probably say is a good time for your own personal reminder that when your tenant renews their lease, use that opportunity to potentially reach out and get it reviewed. So get into the habit of that being your reminder.
Together. Definitely. Yeah, you've just got to pick a time, even if it's tax time or when you're doing your tax return. It's always a good time to also check your interest rate. But yeah, you definitely need to. In this market, I would check it at least every 12 months. But if you can check it every 6 months, definitely do that.
Amazing. Excellent. Well, thank you for joining me today. That was extra excellent information for everyone. So I hope that it either helps trigger some more questions for a time of needing to buy a property or maybe looking at refinancing. And if you are someone that's on interest only, but and that's what's been drummed into you, but maybe you're curious about the principal and interest, it's good just to have those open discussions to find out sort of what other people are advising as well. So thanks for your time. If anyone's got any questions, please feel free to reach out to myself or Di, so diana@loanport.com.au, and obviously you can just Google as well, and I'll put her details here, and both of us are happy to help with any further questions. Thanks for joining.
Thanks, Ash.